Welcome back. We are now busy with Unit 2.4, and in this unit we will be discussing fund policies. Right, the learning outcomes of this section is the following, and you should be able to either describe the general characteristics, terms and features of financial products in a fund policy, explain the typical fee structures, charges and other costs associated with a fund policy, identify the general risks associated with investing, purchasing or transacting in a fund policy, discuss the investing or investment and risk principle options, strategies for a fund policy, validate the appropriateness of a fund policy and the different types of clients or groups of clients. Right, let's look at the definition for the fund policy. Again, in the Insurance Act 2017 defines a fund policy as follows. A fund policy means a contract in terms of which a person, in return for a premium, undertakes to provide policy benefits for funding in whole or in part the liability of a fund to provide benefits to its members in terms of its rules. Other than such a contract relating exclusively to a particular member of the fund or the surviving spouse, the children, dependents, or nominees of a particular member of the fund, and includes a reinsurance policy in respect of such a contract. Fund means a friendly society as defined in Section 1 of the Friendly Societies Act of 1956, Act number 25 of 56. B, a pension fund organization as defined in Section 1 of the Pension Funds Act 56, Act number 24 of 1956. C, a medical scheme as defined in Section 1 of the Medical Schemes Act. And D, any other person or arrangement or business prescribed by the authority. In layman's term, in a fund, your money is invested with other people's money as a collective. Money is managed by fund managers that use capital belonging to numerous investors to collectively purchase different investment instruments as discussed in the previous section. Each fund has a defined investment goal and duration and is designed to meet the needs of the investors with different risk profiles, and the investment manager helps the investors decide if the fund is right for them. Let's look at money market fund. The fund invests in money market securities with a maturity of fewer than 13 months. The fund weighted average duration may not exceed 90 days. The fund aims to deliver a regular income and outperform bank deposits over time while preserving capital. An ultra-conservative portfolio caters to extreme low risk tolerance and is designed for minimum capital fluctuation and volatility. It carries a short time frame for investment. There are no growth assets in this portfolio, and it is a cash-based investment. The ultra-conservative portfolio aims to yield returns that are level with inflation. Capital protection here is the prime importance. So you're not going to really have capital growth, but your capital will be protected. Let's look at equity funds. An equity fund aims to offer long-term capital growth through investing in a broad spectrum of South African and international shares. The fund invests in shares all across South Africa and international stock market sectors. The exposure to South African shares will focus predominantly on the top 100 shares by market capitalization as listed on the FTSE, FTSE or the JSE, Johannesburg Stock Exchange All Share Index, J203. The offshore exposure is limited to 30% of its portfolio, with an additional 10% for Africa ex-SA investments. The fund aimed to achieve its performance objective through well-researched and superior share selection. They may use derivatives, to have an efficient portfolio management process, and for the purpose of that. A derivative is an arrangement or a contract between parties to mitigate or transfer the risk or loss through a promise or a guarantee. So derivatives exist across all asset classes like equities, bonds, commodities, properties, and the money market, including the foreign exchange market. There are now things such as weather derivatives like insurance policies against bad weather. A forward contract locks a buyer and a seller of an asset into a price payable on a specific date in future, which they call the expiry date. Now let's look at an example. Shares that you're currently trading is 100 Rand each. You are not optimistic about the company's prospects, whose shares they are, and you expect the share price might fall from 100 to a lower amount. You agree with a buyer who conversely expects the share to rise, that you will sell them the shares in a 4 month at, say, a price of 100 Rand. Right, on expiry date, that's now the date known as the settlement date or the delivery date. Let's say the share price has dropped, according to your expectations, to 80 Rand. You will then make a profit of 20 Rand on a share, and the buyer will then be forced to pay you the 20 Rand more than the market price. So you've gained 20 Rand. If the share price has risen from 100 to 120, you will have lost out on the 20 Rand increase after paying you the contracted 100 Rand a share, and the buyer can immediately then sell the shares on the market at a 20 Rand profit. For you, the seller, this is a simple way of protecting yourself against your shares losing value, which may or may not happen. Right, the balance fund. This fund aims to achieve long-term inflation beating growth. The fund has a growth asset bias and will invest more heavily in shares. The portfolio manager actively allocates to other asset classes to take advantage of changing market conditions and manage the fund's volatility. The fund is exposed to all sectors of the markets like shares, bonds, and properties. It may gain exposure to foreign assets, but up to a maximum of 30% of its portfolio, with an additional 10% for Africa ex-SA investments. Derivatives may be used for efficient portfolio management purposes. Let's look at your global equity fund. The fund aims to offer superior returns over the medium to longer term by investing in shares from developed countries around the world. The fund has broad-based exposure to quality shares from developed countries across the globe. Given regulatory constraints, this fund remains fully invested in these foreign equities as far as possible. Right, your stable growth fund. This fund aims to outperform inflation and provide a modest income level while aiming not to lose money over 18 months. The portfolio manager actively manages asset allocation to take advantage of changing market conditions. The fund invests in cash, bonds, properties, and shares. The fund may invest up to 40% of its portfolio in equities. The fund may also gain exposure to foreign assets to a maximum of 30% of its portfolio, with an additional 10% for Africa ex-SA investments. Derivatives may also be used for risk management purposes. Right, let's look at group insured benefits. Group risk benefits are designed to assist employers in covering their employees and, at times, their families in the event of illness, disability, or death. Pension funds and preservation funds already form part of group risks. Group insurance benefits are group life insurance, group accident insurance, disability income, group critical illness, and group funeral cover. All group insured benefits and premiums are payable until the employee resigns from the company or when the employee dies or the employment relationship is terminated due to ill health, including disability. The termination of an employment relationship also terminates cover and extended to include the employee's children and spouse. So all those instances, the cover will be lost. Right, let's look at waiting periods. Most group insured benefits do not have waiting periods, but that still does not take away from those that have, as the insurer is mostly concerned about protecting insurance funds. Medical evidence of good health. Let's take Sanlam Group Insurance as subject to a medical proof limit for an employer group providing compulsory group cover to 10 employees or more. When an employer cover exceeds the medical proof-free limit of the scheme, the employee should first provide medical evidence of good health before he or she can enjoy the full potential cover exceeding the medical proof-free limit. An employee is, however, not obliged to go for the medicals. It means the employee will qualify for the cover amount up to the medical proof-free limit without providing the company with medical evidence to prove their good health. Right, additional group insured benefits. Group insured benefits also carry additional benefits that neither the employer nor the employee has to pay an additional premium to enjoy the cover. Some of these common examples are repatriation, a discount on coupons for groceries, emergency medical response, legal assist benefits, trauma, assault and HIV counseling, loyalty programs like information on health, finance, safety, etc. Typical fee structures and charges and other costs associated with fund policies. Fund administrators normally make the schedule of charges available to clients on request. Fees permissible deductions may include management fees, transaction costs such as broker fees, security transfer tax, STT, straight and investor protection levy, and VAT, audit fees, and bank charges and trustee fees. How do we determine the premiums for group insurance products? Some group insurance benefit premiums are calculated using the following: a multiple of the employee's salary, e.g. critical illness, of let's say up to 3 times the employee's annual salary. The insurer and the employee might agree on a fixed benefit amount. A percentage of an employee's life cover might be used to cover all other group insured benefits as mentioned. Insurers sometimes use formulas that are generated after considering the nature of activities, employee size, ages, occupations, salaries at stake, etc. Right, let's look at the general risks associated with investing, purchasing, and transacting in a fund policy. Let's look at the money market fund risk. Here we sit with inflation risk. If the inflation rate exceeds after-tax interest rates, then the spending power of your money will decline over time. This is called negative real interest rates. A money market fund cannot protect from capital erosion should policymakers choose to administer negative real interest rates. The return of a money market unit trust often do not keep up with inflation over the long term. If inflation exceeds the yield, you may not lose a cent from the balance you see on your investment statement, but each cent will buy you less the longer you keep your money in this unit trust. Put differently, money market unit trusts are usually unsuitable for long-term investment purposes, like saving for retirement and or for your child's education, because these things escalate and your money value goes down. What is the credit risks for money market funds? Money market funds invest in debt instruments. If the debt instrument issuer goes bankrupt, investors would likely bear a loss. Some funds, such as the Allen Gray Money Market Fund, try and buffer against this risk through diversification of issuers. The liquidity risk: if, for example, a money market fund receives a request from extremely large withdrawal amounts from its investors, then it may be forced the fund to sell a type of financial instrument commonly used by money market fund called a long-dated paper, which could incur a loss for the fund and for its investors. What's the impact of emerging disease on group insurance products? Most group insurance policies would not have exclusions for viral infections and illnesses, as exclusions mostly focus on scenarios like active participation in riots, terrorism, or wars. For example, in an instance whereby an employee contracts coronavirus, due process in terms of employee benefits would follow. The employee would most likely take sick leave and then utilize their medical scheme should they be hospitalized. In the unfortunate event that the coronavirus leads to death, the member's benefit will be payable from the employee's benefit arrangement. It does not mean coronavirus will never be excluded in the future. Insurers and reinsurers monitor these events and continue to actively manage risks that in an extreme scenario could be detrimental to policyholders and substantially of the broader insurance industry. Any changes to policy terms and conditions will be widely communicated. But what about disability? If the virus is treated early on, the recovery should be fairly quick, and within most schemes, waiting periods of disability benefits. Based on the incidences in China, people can recover quickly from the virus if they receive treatment on time. For this reason, disability claims due to the virus are expected to be minimal. As travel is part of many occupations, regular business trips are often an unavoidable necessity for many employees. Group insurance does not provide travel insurance. However, group insurance benefits are generally extended when people travel abroad. Insurers will typically limit cover. For example, employees will only be covered for the first 12 months of traveling outside of Southern Africa. For group benefits, employers must examine what occupational disability and business interruption plans are in place. If contracting a virus results in temporary disability and staff have used their sick leave, such products would then pay out. If the political environment and the policies drive the country to a recession, actuaries find it difficult to price risks, rate increases and impact on life policies. So if the policy drive a country to junk status, the increased downward pressure on a sovereign rating also places downward pressure on corporate credit ratings. Insurers and financial companies in general are vulnerable to weaker corporate and foreign ratings and when they look to international markets for funding. The appropriateness of the fund policy product for different types of clients or groups of clients. A soon-to-be retiree may focus more on capital preservation than high growth and use a defensive investment with a lower risk return profile. A younger investor would be more likely to get best growth over a long time frame with more risk and thus also more return. The money market fund, this fund is suited to investors who want a liquid investment that deliver a regular income and or a maximum capital protection, but who understands that the investment is unlikely to keep pace with inflation if held for the long term. Now, this would typically be for older retirees. Equity funds, this fund is suited to investors seeking long-term capital growth through exposure to a broadly diversified portfolio of South African and international shares. These investors can tolerate South African and international stock market volatility and exchange rate fluctuations. A balanced fund, this fund would be suitable for investors wanting moderate to long-term growth with less volatility in the short term than the pure equity. It is suitable as a standalone retirement investment. A global equity fund, this fund is suited to investors wanting to diversify their portfolios by adding international equity component or investors who are taking a specific view on global performance relative to other asset classes. Right, your stable growth fund, this will be suitable if you are risk averse and want to prioritize protecting your capital. You are ideally investing for at least a 2-year period. You want to achieve returns better than inflation but are comfortable with a lower potential return over time that you might earn in a unit trust or in something that is a higher risk. You are comfortable with some market fluctuations within a 2-year period. You want a unit trust that complies with legal investing limits for retirement funds. So it will be a more stable type of investment. What is the suitability of group insured benefits? If one has medical issues or bad medical history, this is the right cover to belong to. as there are no medical checks required for basic cover. Medical checks will be required when one desires cover that exceeds the basic limit that the insurer offers the company as a whole. There are no waiting periods on group benefit or insured benefit policies. The cover is effective the day one starts and contractual working relationship with an employer. If one is looking for a policy that are beneficial in their well-being as an employee without paying much for cover, group insured benefit policies is the way to go. If for women, if they join a medical scheme and are pregnant, medical aid will not pay. Group insured cover for medical aid has no waiting period on maternity benefits. Right, fund or fund member policies. This is the last part that we are discussing here, and then we'll move on to our next unit. The term fund policy is defined to mean a contract in terms of which a person, in return for a premium, undertakes and to provide policy benefits for funding. So we are just concluding our session where we started it. In whole or in part, the liability of a fund to provide benefits to its members in terms of its rules, other than such a contract relating exclusively to a particular member of the fund or to the surviving spouse, children, dependents, or nominees of a particular member of a fund, and includes a reinsurance policy in respect of such a contract. Right, a fund policy therefore is a policy that provides benefits to a retirement fund. It is normally taken out on a group basis. The regulations of the Long-Term Insurance Act also describes a fund member policy. It is an individual policy entered into by the fund for the exclusive purposes of funding that fund's liabilities to the members in terms of the fund rules. So this ends our session on fund policies. Our next session we will discuss is Unit 2.5. There we will look at sinking fund policies. Thank you very much for attending.